It's time for Yahoo Finance's Market Minute. Stocks sliding after 2 consecutive days of gains as focus turns to the Fed decision tomorrow. Tesla under pressure as Chinese rival BYD unveils an ultra-fast charger that can refill an EV battery in just 5 minutes. That's double the speed of Tesla's fastest V4 superchargers that roll out this year. Shares of BYD up on that news. Now Lucid jumping on an upgrade from Morgan Stanley to hold from sell. The analyst Adam Jonas citing a couple of tailwinds. One, the ability to capitalize on AI strategy, and 2, optimism around Lucid's new CEO. And Alphabet is buying cybersecurity firm Wiz for $32 billion. That's the tech giant's second attempt at the acquisition after negotiations fell apart last year. Wiz deciding to pursue an IPO on its own at the time. Now Wiz will join Google's cloud business when the deal closes. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below. Track the stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Market Checkup. One portfolio manager describes why 2025 is the time to lean into the value trade. And Harvard is offering free tuition for families making under $200,000. But the big question is, are all of your costs really covered? We discuss with an expert from the Princeton Review. Plus, it's Travel Week on Wealth. Ahead of the spring and summer travel seasons, we're bringing you tips for families to budget wisely for that upcoming vacation. All we ever wanted, got to get away. All right, but first, we take a look at some of the market action. 90 minutes into the trading day, stocks sliding as volatility continues following 2 winning sessions that we have seen. Take a look at the major averages down across the board. The NASDAQ leading those declines right now by about 2%. The top mega cap tech names have been taking a beating so far this year, with the Magnificent 7 ETF down over 12% year to date. And as the tech trade unwinds, our next guest says 2025 could be a tough year, and it's a good time to lean into the value trade. Here with more, we've got Matt Powers, Powers Advisory Group Managing Partner. Always a great pleasure to grab some time with you. So let's just take a step back and just define the value trade and how you're kind of assessing the opportunity within that element for folks' portfolios out there.
Hey, Brad, good morning. Thanks for having me. Yeah, it's there's been a big shift from the last 2 years. This narrow focus on the Mag 7, the AI trade is getting hit hard in 2025. You just showed those numbers. But those same stocks made up, half of the S&P's returns last year. Now they're down, 12, averages 12%. It's driving a lot of the market losses this year. We all know valuations were stretched, and now they've come to reasonable levels. But there's momentum. There's a reversal trade taking place. Kind of came quietly, but it's in the forefront now. We've got sectors like healthcare, staples, and materials leading. I say this a lot, but this year is just gonna look a lot different than what we've seen, and could shape up to be a tough year, especially broad-based index investors. It's easy to index on the way down. But the bottom line is we're moving back to where you have to be more selective, back to some of the tried and true fundamentals, which leads into that value trade.
And so what is an investor's checklist for other opportunities and identifying those other opportunities given the unwind that you were mentioning within the Mag 7?
Yeah, it's, so some of the sectors, I guess if you went into the sectors that we like, they're not exciting. It's not names that they're household names, put it that way. But we're looking, more of an entry point into traditional names with incredibly strong fundamentals. And, they're ones that we like, and they continually hit our screens. And we think this is exactly what investors should be looking at right now. There's really no need. I mean, right now you could buy the dip, which historically is the right move for long-term investors, but there's no need to make drastic allocation shifts until all of this heightened uncertainty settles. We all know what it's around. The word tariff is thrown out. I mean, you've heard it more than I ever have. And, leaning into that value trade, into dividends, and overweight some defensive areas of the market, uncertainty always drives volatility. But that combination of growing dividends and attractive relative valuations, it gives investors a higher level of predictability.
Yeah, for many investors, this is the first time that they've heard the word tariff this much, especially as compared to the last 10 years, according to FactSet. This is the first time that we've seen this many mention of tariff on earnings calls for S&P 500 companies over that 10-year time span. So all of that considered here, within the value trade, are there specific picks that you would be monitoring right now and suggesting to some of your own clients?
Yeah, going back to that, our picks, they're again right now, and I think this is where you need to be. They're not exciting, but it's somewhat of a level of protection, and which is tough to find right now. So one thing I'd like to say is that we're seeing this rotation out of tech, but it's not moving to cash. It's actually moving to other areas, and two areas we like are leading, two of the leading sectors year to date, but healthcare and staples. I mean, healthcare clearly defensive. They've got a headwinds from aging population. Should drive long-term demand, and essential services are always there. And consumer staples, I mean, steady, reliable, dividend payers, lower volatility. It's some of this inflationary issues, they can pass on the rising costs without losing demand, but specific companies. So in healthcare, we like J&J. They've got an attractive relative valuation. Yields a little bit lower, but they've got a long history of growing it. We all know they've been in and out of legal battles, it seems like forever. But the stock's maintained its strength, and we like Pepsi. So interesting one here. It's trades well below its 5-year average PE, forward PE at 18 versus 21. And it's lagging the staple sector, but a great dividend payout. And yesterday, I think everyone has seen this news. I didn't know much. We liked Pepsi before this, but they announced the acquisition of Poppi, which is a healthy soda. My teenagers love it. Had never heard of it until just recently, but they're always wanting it. For around $2 billion, it's that traditional soda sales are declining and moving towards a healthier direction. So on surface, it appears to be a positive step in the right direction.
Matt, always a pleasure to grab some time with you, and seeing the bracket roll out. Good luck to Duke in the coming weeks as well.
Thank you. Agreed. SIUE, upset alert. That's my son's school. So
there you go.
Good talking to you.
Thank you. Likewise. Good to see you. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, U.S. listed shares of Grab Holdings. They are rising after the ride-hailing and food delivery company said it's going ahead with its attempted takeover of rival GoTo Group. This is according to Bloomberg. Now, Grab is assessing GoTo's accounts and operations. Talks are reportedly ongoing, but may not lead to a transaction, according to people familiar with the matter. Grab Holdings is backed by Uber. Next up, PepsiCo downgraded to equal weight from overweight at Barclays. The price target reduced to $156 a share from $168. The analyst citing some concerns over the snacking business, particularly in the Pepsi brand Frito-Lay's, which has seen 6 sequential quarters of volume declines. The analyst also says the economic pressures have weighed on the snack market overall. And finally here, Ralph Lauren getting an upgrade to buy from neutral at Goldman Sachs. Price target set to $286 a share there. That is 30% upside from the stock's last close. And the analyst sees recent volatility in consumer discretionary as a buying opportunity in strong brands. The analyst saying improving execution and brand momentum will help gain market share and expand margins. The analyst also mentions that Ralph Lauren has limited exposure to risks like tariffs, department store slowdowns, and health of lower income shoppers versus competitors. Another trending ticker this morning, Nvidia CEO Jensen Huang takes the stage today for the company's annual GTC conference. Our very own Dan Howley is on the ground in San Jose, California, and joins us now with the latest there. Dan, all right, the sun's out since the last time we checked in with you. What are we anticipating here as Jensen Huang is set to take the lapel mic, if you will?
Yeah, Brad, we're expecting a slew of announcements from Nvidia here with the SAP Center in San Jose. And essentially the big news that we're looking for is around NVIDIA's next generation lines of chips. There's expectations that we'll see what they call the Blackwell Ultra. And then beyond that, the Vera Rubin line of chips that they have kind of hinted at in the past with some roadmaps. So hopefully we hear more about those. I think the big deal we're going to see is NVIDIA addressing all the fears around DeepSeek. I remember when DeepSeek was shown off in late December that it sent NVIDIA shares plummeting, as well as a number of other AI stocks, just on the fear that that model being built reportedly for about $6 million compared to the hundreds of millions of dollars that Silicon Valley companies had spent, meant that they wouldn't have to purchase as many high-powered GPUs. And so NVIDIA has been pushing back against that, essentially saying, look, these reasoning models, these thinking models like DeepSeek R1, like OpenAI 1, like Google's Gemini Flash thinking, they benefit from more high-powered chips. And the reason being is that with those chips, they're able to reason faster and provide faster responses than if you were using low-end chips. So expect Jensen to dive into that, kind of go through how these reasoning models are going to benefit from NVIDIA's latest lines of chips. And then there's also the discussion on quantum computing. Now, that's something that's raised eyebrows. Jensen Huang had said that quantum isn't really near a practical use case at this point. Other CEOs like Google Sundar Pichai have said, well, it's 5 to 10 years we'll see something. But the reality is nobody really knows at this point. But NVIDIA is hosting its first quantum day. So that's very important to look out for. There'll be CEOs from quantum firms having a panel discussion with Jensen. And I think more broadly, you can expect plenty of software announcements from NVIDIA. We talk mostly about the chips, but they are a software company as well. They offer a plethora of software options for taking advantage of their chips, as well as building additionally on those. So it's going to be a packed show.
All right, Dan, we see the sun rising over some of the skyline there, hitting the SAP Center behind you. Will allow you to get on inside and take a look at the vibe that's really transpiring in a moment from now. Thanks so much, Dan. Coming up, we dive into the state of the housing market with the latest data showing an uptick in new home construction. But how big of an impact could it have on supply? That's the big question. We dive into that after the break. New home construction surged more than anticipated in February, up more than 11% from January. Senior reporter Danny Romero joins us now on set with more here. So, Danny, what do we know?
Brad, builders broke ground on more housing projects in February. Housing starts rose more than 11% to a seasonally adjusted annual pace of 1.5 million units. And that beat economists' expectations, who were expecting an annual pace of 1.38 million units. The rebound in housing starts really was led by single family construction. And what's really interesting from all of this is that this data comes out when home builders are really feeling not that confident about the housing market, and that they're dealing with President Trump's tariff policies, the ongoing challenges of high housing costs. Remember, Trump last week imposed a 25% tariff on all imported steel and aluminum products, a policy move that will likely push housing costs even higher. According to the National Association of Home Builders, they revealed in their March survey that they're estimating that tariffs could increase the cost of a home by $9,200. And economists are expecting that home builder confidence will likely fall, and it then also will put pressure on new construction during the second half of this year.
And Danny, Redfin data out this morning as well that we just saw says that home prices in February actually grew at their slowest pace since July on a month-over-month basis. What can you tell, Sarah?
There's good news for both buyers and sellers as we kick off this spring selling season. Like you said, Redfin reported that U.S. home prices rose 0.4% in February on a monthly basis. That is the slowest pace since July of 2024. The combination of mortgage rates moving lower, also the slower price growth, could bring out more buyers from the sidelines. However, some areas in the country, like Texas and Florida, are dealing with homes sitting on the market. But this is an opportunity for buyers to negotiate the price. It's becoming more of a buyer's market in some areas. In some areas,
okay. Danny, we're going to be watching closely for where it becomes a buyer's market in other areas too. Hopefully that grows out a little bit more. Appreciate it, Danny. The Trump administration is taking steps to combat housing affordability. Secretary Scott Turner and Secretary Doug Burgum announced the formation of a task force to identify federal land where affordable housing can be built. Jessica Lautz, National Association of Realtors Deputy Chief Economist and Vice President of Research, joins us now. Jessica, what would efforts like this ultimately take? And then what type of relief could we see on the affordability side if this were to come to fruition?
Yeah, absolutely. Thank you for having me back. So, I mean, certainly, if we can free up any land to actually build homes, especially at affordable price points, that could be some relief for home buyers who really have been shut out of the market in the last few years, especially as we think about this inventory crisis. Now, if we look at areas perhaps like Las Vegas, that could free up some inventory. And we know that home prices have really been on the rise in that area.
And so what else does the federal government, also in tandem to just freeing up land, need to do to combat the affordability crisis?
So when we think about the affordability crisis and we think about the inventory crisis, a lot of this is actually based in local markets, in local regulations. As we think about this, it really is helping to free up building at the local level. And some of that really does come down to NIMBYism, not wanting this new development in my backyard, but really thinking about how we do need that development to come in. So perhaps thinking about adaptive reuse, using those vacant hotel motels, those vacant schools to bring in residential units could really be helpful in local areas.
You know, this is interesting because we've also seen some of the climate considerations and insurability in specific markets also impact the home buyer sentiment and ultimate kind of thought process. How are you kind of measuring that up against some of the typical hotspots that we've seen in years past versus where some of that insurability is taking a hold among buyer mindsets right now?
Well, certainly this is a nationwide issue when we think about just adding on insurance into the cost of home. And so while we think about perhaps weather events happening in localized areas, that actually does impact on a nationwide scale. But I think what we're looking at is home buyers really factoring in the total cost of ownership. So thinking about insurance costs, but also thinking about what are my commuting costs if I now have to be into work 5 days a week when perhaps I could work remote. All of those are big factors when we think about how consumers are approaching homeownership. And perhaps that's been a little different than what we have seen during the pandemic years versus where we are right now.
All right, I got to hustle to my finish here, but I want to get into two topics. One of them, spring home buying season. What are your projections there? What are you anticipating?
Well, certainly we are expecting that there will be more homes coming into the market. More inventory could help for consumers, and we've started to see a trickle of that. Certainly, hopefully, home buyers are really having better traction this year than they had in the last 2 years with more inventory and lower interest rates as well.
And then another major topic here, especially as we're considering and going into that home buying season, and how this could prove beneficial or a major pivotal season for different ethnic groups, and particularly the National Association of Realtors, the NAR study that looked across Black home ownership still trailing white home ownership in 2023. What did we ultimately see kind of transpire into 2024 for Black American home ownership? And what are some of the pivotal aspects of this home buying season that could ultimately perhaps narrow that gap and the 30% trailing that you were mentioning?
Yeah, so brand new report, hot off the presses from NAR just yesterday. What we saw is a growth actually in Black homeownership. That being said, that gap is very persistent. It's still nearly 30 points as wide as what we see for the white homeownership rate, which is actually above 70%. So when we look at that gap, it's very persistent. What I do think is important, though, is that we did see growth there. The other thing that is very important is that for all non-white home buyers, what we see is nearly half of them are actually first-time homebuyers, really led by Black homebuyers having a really predominant share, being first-time homebuyers in the market. So really trying to enter into homeownership and really surpass the odds.
I want to get off the sidelines myself, Jessica. I'm ready to throw my hat in the ring on some bidding soon. I got to save up a little bit more, though. Jessica, appreciate the time.
Thank you.
The price of food is beginning to increase at a slower rate. It's up 0.2% month over month in February compared to the 0.4% rise in the month prior. But the escalating global trade war could have a negative effect and send prices higher once again. That's what we're tracking up against here. And joining me now, we've got Ricky Volpe, who is the former USDA economist and Cal Poly professor of agribusiness. Good to have you back on the program. Always value your insights. How are you viewing the potential impacts of tariffs on food prices?
Well, yeah, thank you for having me. Been getting a lot of questions about tariffs recently, and what makes this challenging is that the situation is so fluid, as I'm sure most of your listeners know, the tariffs are announced, and the tariffs are sort of partially pulled back, and then in some cases immediately pulled back entirely. There's absolutely no question that tariffs with our major trade partners represents a distortion. And, in the short term, just market distortions almost always increase prices. So it is something that I'm concerned about, since we just wrapped up, 2024 was a year of below average food price inflation. There was a little bit of relief for customers. Despite all the headlines about eggs and a little bit about beef and sugar and a few other commodities, most food prices right now are still trended in that direction towards, lower than average food price inflation and increased affordability. Tariffs have the potential to change that, but the extent to which tariffs could affect food prices, of course, depends on the countries they're being slapped on, the perishability of the products we're talking about, the importance of imports to how much of it we consume or we eat in the U.S. And then another factor that I heard you talk about with a previous guest are the recently announced tariffs on, steel and aluminum, these sort of fundamental industrial building blocks. They don't often get talked about with respect to food, but there's absolutely no question those are going to drive up packaging and storage and transportation costs for food. They have the potential to drive those costs up in a big way.
Yeah, and this has a lot of the food and beverage industry executives trying to make their case for certain exemptions so that they don't get hit and have to then pass that price on to the consumer. But I guess from your early evaluation and predictive analysis, based on what we've seen in the past, are there parts of the basket, and which parts of the shopping cart are most prone, based on the countries that we're having the negotiations with, most prone to potentially seeing higher prices in this near term?
I think let's assume that the tariffs that President Trump has announced or threatened with Canada and Mexico, if we assume that they go fully into effect at the rates they've been announced, then I would expect to see the quickest and largest impacts with respect to fruits, vegetables, beef, and liquor. Those are the areas where we can expect to see those impacts, because we're talking about commodities when we talk about beef, tomatoes, avocados, and then of course when we talk about tequila and certain beers and bottled liquors. Some of these products, our trade relationships with Canada and Mexico account for nearly all of our domestic consumption. So it's not like we have other trade partners that we can pivot to if these tariffs go into effect. There's really no choice but for these food companies, these importers and manufacturers and so on, to sort of pass those on to consumers because they're already operating on thin margins.
While we have you, I want to talk about a development that we've seen out of a major company, a household known name in Dole. They are taking some efforts and actually raising their pineapple prices, but as we think about the broader kind of citrus category, if you will, that Dole is known for, especially in the fruits and whatnot, how are you evaluating this, and what are the other foods that could potentially be in danger of some of those price fluctuations higher?
Yeah, that's a great point. We haven't really been talking about citrus fruit much recently. Of course, eggs have been dominating the headlines, and I'm actually kind of thankful that we haven't been talking about eggs today. But citrus is facing sort of a two-pronged assault right now. Domestically, as a lot of folks know, citrus greening is a disease vector that's affecting citrus production in the southeast United States, mostly Florida. We don't have an answer to it yet. Producers don't have a solution to it. So we're seeing the production of processing fruit in the American Southeast declining really rapidly, and that's already translated into a higher cost for orange juice, as a great example. And then there's sort of a latitudinal belt on the globe that stretches from Central South America over to Africa that's been experiencing a lot of wild weather in the last few months. And that's been affecting everything from, you mentioned pineapples to other citrus fruits to avocados at some point to sugar and to cocoa. And these are all categories that right now we're starting to see inflation really pick up. So a lot of it has to do with weather. The domestic issue, the domestic side of that right now is sort of systemic, and we're looking at that to be baked into the cake for years to come.
Oh my goodness. All right. You've given me a new rabbit hole to go down after I get off the set here. Huanglongbing, I believe it's called, as the technical name, HLB for citrus greening, as you were mentioning. I'm going to be looking into it a little bit more. Ricky, thanks so much for taking the time.
Thanks. It was great.
Coming up, everyone, Harvard announcing free tuition for students whose families make $200,000 or less. We've got the details after the break. Harvard announcing accepted students from families making under $200,000 a year will get free tuition. The Ivy League, just the latest school to give free tuition to some students following MIT, Stanford. You've got Columbia, who's also made the announcement, and more who have similar programs. So what do students and parents need to really know about these programs? Joining me now, we've got Rob Franek. He is the editor-in-chief of the Princeton Review. Rob, good to have you here with us. So what do students need to know, and is it really free?
That's the trillion-dollar question, Brad, and I appreciate the opportunity. Well, free tuition is free tuition. So when we think about sticker cost, and we could have talked about this all the time at the Princeton Review, total cost of attendance is the big four, and that is tuition, room and board, fees, and books. So if the family is making $200,000 or less at Harvard, that takes care of tuition, which is about $56,000. It leaves $26,000 in room and board, fees, and other costs for students. So just to keep an open mind, this is a tectonic shift, as you had noted, from $85,000 to $200,000. Hats off to Harvard and the other schools that are able to do it. MIT, University of Pennsylvania, starting this trend as well. But again, just thinking about how attractive this is to so many college-bound students and their parents because debt is such a specter.
Why do you think this makes sense for the schools, for the universities to be rolling out?
Well, a couple of reasons. Number one, schools, Harvard on down, want to attract lots of different students to their school. And addressing the number one fear for students and parents, which is debt. We've been collecting this information for 13 years now consecutively at the Princeton Review. The biggest fear has been assuming too much debt to pay for college. So addressing that head on, saying, we see you, we hear you, we understand that debt is a big issue for students and parents, and saying that if you're under this threshold, then you should not have the same fears that other students might have. So I feel like doing that is a good move. We should also know that colleges have been doing this for a long time. There are over 100 schools across the country that have different financial thresholds from $30,000 on up. So there's lots of schools besides the Ivy League that are doing this as well.
And so as you're thinking about this, how does this kind of reset the mindset for a lot of people, families, potential enrollees in these classes and in college experiences about what they should be considering when choosing a school and the best schools for their money?
A couple of things, and I'm glad you brought up the question. We talk about this all the time at the Princeton Review. It's about fit, right? So addressing financial concerns is a big part of fit. It's a four-part process. So an academic fit, obviously, campus culture fit, financial aid fit, and career services fit. So we talk about this to make sure that a student's going to be happy not only in the classroom, but engaged in that community outside the classroom as well. And I think taking away this financial, nervousness and worry is a big driver to get to students to a place of confidence and their parents as well.
And certainly. And so as we're thinking about what is really attracting students right now, it's trying to make sure that they're choosing the school that has the major that is going to make sure that they are insulated from any type of economic cycle or change in labor market needs. What schools are adequately doing that and making sure that their majors reflect what the real economy is moving towards, and what are some of the best majors that might be recession-proof or economic cycle-proof?
Oh, Brad, I appreciate this question. Thinking about what is going to be our students' return on their investment, their academic investment if they're students, and their financial investment if they're students and families, and factoring out what's going to happen through a career development, career resource center when a student is on campus. One of our most popular ranking lists at the Princeton Review is our best career services ranking list. So I think what you're going to find, or what parents and students are going to find, are schools that are addressing career development through internships and co-ops and experiential learning. What are students doing from first year in college through senior year to complement what they're studying in the classroom with an outside of the classroom experience? And this is glorious for students because it's vaulting them onto jobs of substance upon graduation or onto a professional school and then jobs of substance. And you had noted just a couple of Teflon, areas, career disciplines that students are moving into. Certainly thinking about healthcare workers and education. So we need teachers and healthcare professionals without question. Anything in business management, from accounting, finance, finance, marketing in incredible need. And then also computer science, different verticals for game design, sort of the cross section between art and computer science. We have a new ranking list out on that today as well at the Princeton. So just really good stuff. And I think students can get excited about it.
Rob, I got to hustle to my finish, but I'm going to try and squeeze in two quick questions here. Number one, more people applying to law school amid recession fears. Is now the time for people to say, all right, you know what, law school, grad school, maybe I should be looking into that opportunity?
If history proves true, Brad, then that is likely going to happen. Any downturn in the economy, question of recession, students or prospective students think about upskilling. So moving on to law school, business school particularly, but grad and professional schools in general. So I think we're going to see that moving forward as we move forward in our times.
Just lastly here, what needs to be the pitch from colleges, from university, higher education more broadly, in the U.S. education system, especially as you're seeing more of a reconsideration from some of the countries who we've been trading partners with, some of the countries who have sent their students, their family members here, but are noticing that there's a shift in the mindset from some of our political leaders and trying to figure out, okay, how does that translate through to what ultimately is going to be valued and whether or not we're going to stay in a different schooling or education experience?
Yeah, it's a super good question, and I appreciate it. I would say that college is worth it. It is worth it for any number of reasons, and holding up the American model as, superlative in that way, thinking about what students will do with their degrees. They report far lower unemployment rates throughout their career lifetime. They make $1 million+ more. So when we think about just the value of the American education system, I don't think that is going to change as we move forward. And just to remind students of that, that's what I'm doing out here every day, students, parents, and counselors.
All right, Rob, maybe we'll do this from a PJ Pancake House or something next time we discuss.
I'd love it. Good to see you.
Good to see you too. Thanks. Coming up, we're going to help you tackle some financial anxiety with 3 tips to handle all this recession talk that you might be hearing. Stay tuned. Consumer sentiment dropped to a 2.5-year low as inflation expectations rose amid President Trump's recent tariff campaigns. The data from the University of Michigan, alongside the recent move to the downside in equity markets, reflect many of the financial anxieties Americans are currently feeling. We want to wade through some of these anxieties and give people some actionable advice to handle their money in this moment. Here with more, we've got financial therapist Amanda Clayman. All right. Deep breath here. Amanda, where should we begin here, especially as there is market uncertainty amid this recent downturn? How do you make decisions about where to put your money in an environment like this?
Ideally, we make decisions holistically as opposed to reactively to some very distressing emotional triggers here.
Certainly. Okay. And so with that, how do we cope with that financial anxiety that naturally arises, and what are some actionable steps?
Yeah, the first place that I really like to begin with people is taking the opportunity to notice how we are experiencing our body. Fear is really, really felt in our physiological arousal system. You may have heard fight or flight as a reaction. And a lot of us, when we hear distressing financial news, go into that fight or flight reaction. So we want to engage the body and speak to the body in the body's own language. And one of the ways that we can do that is with breath. A really great technique is what's called 4-7-8 breathing, where you breathe in, you inhale for a count of 4, you hold the breath for a count of 7, and then you release the breath slowly over a count of 8. And this is a way that we can, even without changing the content of our scary thoughts or changing our environment, we can start to at least begin to respond from a more regulated place.
And so with that in mind, as we're thinking through so many decisions that people hopefully aren't just making by themselves, but talking to their partner with, how can you make sure that those actionable steps are involving that conversation with your partner, with your family members, whoever you have to kind of try and pour into that and relieve some of that stress from just making the decision in a silo?
Talking to people is a really great way for us to kind of engage a larger brain, if you will, more than just kind of what our own thoughts or our own reactions are telling us. It's helpful, I would say, in ideal circumstances, if we already have a regular practice of talking with some trusted folks. Maybe that's an advisor, maybe that's a spouse or partner, or somebody else who we really trust their perspective when it comes to what's happening in the markets, when it comes to decision making about money. So yes, ideally we have those conversations already in practice. But if this is new, the place that we would really start in being able to bring this up into a topic of conversation is, boy, I'm really worried about this situation, or I'm having some scary thoughts about volatility in the market right now. So to frame it not necessarily as what I'm looking for is advice on what I should do with my money, but really like I want to connect with you from a place of what my concerns are, what my fears and experience are. And that can help us to let the other person know what it is exactly that we're looking for.
This also comes back to how people think about their overall career prospects or employment opportunities. And that's something that we've been consistently tracking month over month in prints like the Consumer Confidence Index. And so with that in mind, how can the career outlook factor into making these financial decisions?
It's interesting. I've been in this space for a couple of decades now. And in the time that I've been practicing financial therapy, I feel like the trend overall has been that work is in many ways becoming more episodic. We're having portfolio careers. Flexibility really is a wonderful skill and mindset to have as we approach our long-term career path planning. But that means really going back to the first point, getting out of reactivity. We don't want to just be jumping from choice to choice, path to path because we're stressed out. We want to be able to respond to some of these environmental cues that may be telling us, hey, the economy is trending away from this. We're seeing impacts from AI, for example, and thinking about, is my career path going to be impacted by some of these changes and developments with AI? So we do want to be responsive to things, but it helps when we can track these things over time, really engage with this as an ongoing conversation that we're having about our lives, as opposed to the place where I think a lot of us are coming into it, which is, oh no, there's danger, and I really have to act fast in order to avoid this danger.
Amanda, thanks so much for taking the time here with us today.
Thanks for having me.
U.S. unemployment remains historically low at 4.1% according to the latest jobs report, but the University of Michigan's Consumer Sentiment Survey found the share of U.S. consumers expecting unemployment to rise topped 60% in the month of March, its highest level in over 6 months. If you're wondering how you can prepare your personal finances for higher volatility under the Trump administration, we have David and John Ottenschneider, the debt-free guys and the hosts of Living Not So Fabulously, here with their tips. Great to see you both. John, what should you do if you're concerned about job cuts and other economic uncertainty?
Yeah, we have some tactical tips here for you to complement Amanda's suggestions. Our first suggestion is to set up a arm's length away emergency savings account. And with whatever amount you can contribute on a reoccurring basis, go ahead and start contributing to that as soon as possible. But the question is, what's an arm's length away savings account? Well, it's one that's not at your current credit union or your current bank, and it has no fancy features like check writing or debit card. You want to try to create somewhat of a roadblock so you can actually say, talk to the hand rather than looking at my wallet when you're trying to buy something that might not actually be an emergency.
And so, David, how can you adjust your spending habits there?
Yeah, so Brad, one of the things that we love is we have some friends over at Price of Avocado Toast podcast. They shared with us one time their definition of budgets, and they say we all really have two budgets. We have our sushi budget and our can of tuna budget. Our sushi budget is when our personal financial economy is doing well. Our can of tuna budget is when it's not doing so well. And so if you are thinking about, or your job has been doged or possibly is going to get doged, focus your spending on necessities. It may be time to put a little bit of a hold on some of that unnecessary spending.
I'm not sure if I was ready for doge to become a verb yet, but here we are. John, how can your credit card help you save?
Yeah, different credit cards have some great tools that you can use. And one such credit card is the 0% on new purchase credit cards. So if you don't have a flush emergency savings account or you've run into a precarious situation, maybe consider getting one of these types of credit cards and consider applying for and adding payment protection insurance or PPI to this particular credit card. And what that'll allow you to do is it'll cover you in case you're not actually able to make payments on time. It's a great way to protect your credit score and reduce some financial anxiety, but you want to investigate the costs first, and don't forget that the insurance won't actually cover your entire payment in perpetuity. It'll only cover your minimum monthly payments for a limited period of time.
Well, I suppose that raises the question, David, then if you miss a payment, what should you do?
Well, the most important thing here is to communicate with your credit card companies, especially before you've missed a payment or that payment date comes due. Ask if you can have a waiver of the fee for that missed payment if it hasn't happened yet, or if it's the first time. Then you might want to move to some other strategies, like asking if they have a temporary hardship program that may allow you to lower your payment, lower your interest, or waive some other fees. The other thing is you can ask to have your payment date moved out. We've done this personally. You can move your payment date out so that maybe if you are just running a little bit behind on money and you will be able to make that payment, you can hit it. Probably the last resort here is to look at maybe a balance transfer card that has a zero interest so you can actually reduce your monthly payments.
John and David, thanks so much for taking the time here with us.
Thanks for having us.
Thank you.
And everyone, you can listen to new episodes of Living Not So Fabulously Wednesdays at noon. A programming note: in this week's episode of Decoding Retirement, host Bob Powell speaks with the author of Retirement Planning Guidebook about the tools that you need to mitigate risks in retirement.
It's great to live a long time. It's just financially more expensive. And so longevity risk is the risk you live longer than expected and outlive your financial plan. If you're retiring in your 60s and your life expectancy is your 80s, there's a 50% chance you live beyond your life expectancy. So then you may start, well, what if I outlive my assets? What if I have to plan to age 95 or plan to 100 or whatever the case may be? And then with an investment strategy, that means spending less to make sure you can stretch those assets out over a long-term horizon. So with managing longevity risk, the key things you have available: delaying Social Security helps to provide a lot of longevity protection, especially for the high earner in a couple whose benefit will become a survivor benefit potentially as well. And also using risk pooling type products such as annuities as part of the planning process can help manage that longevity risk as well.
You can catch episodes of Decoding Retirement Tuesdays, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Coming up, planning your family vacation, we're giving you all the tips that you need to take some well-deserved time off without draining the kids' college fund. That's next. 40% of consumers say they're prioritizing spending on travel this year. That is up from 28% in 2024, according to a Bank of America survey. So, how can families work together to fit travel into their budget? Joining me now, back on set, we've got Mary Hines-Stroh, who is Bank of America's Head of Product for Consumer Business and Wealth Management, Banking and Lending. Great to see you again.
Great to see you.
So let's talk about this here a little bit, because consumer sentiment data shows many Americans are feeling uncertain about the U.S. economy going forward, but we all need some relief, some relaxation, some rest. Should they be prioritizing travel over saving right now?
Well, you want to be financially responsible, and having financial stress is not good. So you certainly need to have a cushion. We recommend between 3 months to a year of your monthly expenses in that cushion. But it doesn't mean you have to cut travel out altogether. You just need to do it in an affordable way.
So how can families fit travel into their budget? What are the first steps that they need to be taking?
Well, what's really helpful is to be flexible. Now, that's harder when you have kids because you're sometimes bound by their vacation. But look for things that you can do that you can drive to instead of flying. Go off peak. Also, instead of renting hotel rooms, which can be really hard if you have a large family, you might need 2 or 3 rooms, rent a house. That enables you to cut costs on hotel, but also then you can eat in that house sometimes instead of going out.
Certainly. So what are the best ways to save up for a planned vacation, putting those expenses together and really knowing what the marker is that you need to hit?
Yeah, well, come up with what your budget is. Where do you want to go? I just got back from a ski trip with my family.
Congrats.
Thank you. I survived, is all I'll say. But that's expensive because you have the equipment, the lift tickets, the airfare. So really lay out what your costs are for that vacation and put a target date for it, and then allocate a certain amount of money with every paycheck to that account. Either create a separate travel account or use some automated tools that move money directly from your checking account into your savings account.
And what about couples? How can you work together to prepare for a trip?
Well, that can be hard because couples aren't always on the same page. And so that's start with, what are your priorities? Where do you want to go? Like with my family, my husband likes extra legroom. I don't care. I'm short. I'd rather have a nicer hotel. So figure out what means the most and come up with that plan. And remember, not everything has to cost money. If you go on a beach vacation, you just really need a bathing suit. Hikes are free. So have that balance of those special excursions that cost money with just doing things together.
Some key reminders there. So also, how can families find deals to maximize savings?
Well, there are a lot of apps out there that collect all of the deals, and you should really look at those to make sure you're getting the best price on whether airfare or hotel. Also, take advantage of all the loyalty programs for airfare, hotels, excursions, because then you can actually earn rewards to help pay. And then always use a rewards card when you're traveling or making those purchases so you can offset yours. Like the trip I just took to Utah, all of my flights were covered by my Bank of America rewards points.
Wow, all right. Sounds like you're layering some rewards out there and putting those all together to make the trip happen. Mary, thanks so much. Sounds like you guys had a great trip. Let's do a final check of the market here. Taking a look at the Dow, the S&P 500, and the NASDAQ, we are lower across the board off of the session lows. The NASDAQ still down 1.9% though. The Dow fractional declines there, 0.9%. S&P 500, that moving lower by 1.3%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. That does it for us, but you can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You don't want to miss it.